All right, Mr. Francie, let's dive deep into our first topic of the rising bond yields. Now, let's just set the context, Patrick. Number one, I'm going to put up a chart here real quick on kind of where they were and where they are currently, but we've had quite a sharp increase in bond yields. But first, let's kind of talk about why that's important, especially for us real estate investors. We're investing in real estate. Why the heck do we care about bond yields?
Well, the 5-year Government of Canada bond directly influences the 5-year fixed rate mortgage. And what's been happening over the past several months actually is it's been uncharacteristically volatile, and it goes up and it goes down. So what does that really impact us? It affects our fixed rates. And so we're going to start to see, based on what the show we're doing today, we'll probably see a tick up in the 5-year mortgage rates next week. And, it's interesting is that this just literally happened, as in they ticked up within a 2-day period to, I think, 3.30. I think you have a chart on that. But ultimately, that affects the 5-year term. And so now people are, okay, do I got to rush out? Do I got to go get pre-approved? Can I get something locked in before next week? I don't know that this can all happen, but that's the bond and the effect of it.
Yeah, and it's interesting because a lot of people see that the Bank of Canada is raising interest rates, at least they have been for the last year. And that's kind of funny, Patrick, right? This has only been happening for a year. It kind of feels like this tornado has been happening for a long time, but they've only started raising rates roughly about a year ago, maybe 13 months. So the point there is that the Bank of Canada's rate, the overnight rate, that is not, I just want everyone to know, that is not what determines the 5-year fixed rate of mortgages. It's the bond yields that determine the 5-year fixed rate of mortgages. But variable rate mortgages are determined by the overnight lending rate, which is set by the Bank of Canada. So I just want to kind of show everyone the difference between a variable rate, where it comes from, and a fixed rate, where it comes from. This definitely is going to have an impact, but I just want to kind of take people also back a little bit down memory lane. If you look at the chart we put up here, like you said, Patrick, it was at 3.3% earlier this year. Then it went up to 3.4. It went all the way down to 2.8, and essentially its trading range has been between 2.8 and 3.6. And as you mentioned, that's quite a volatile range for this bond yield because typically it's quite stable. So this has been happening, and 3.3 is definitely towards the upper end of the trading range. It was at 2.8% for the last give or take about 2 months, somewhere between 2.8 and 3. And as a result of that, mortgage rates had come down. You started hearing about investors being able to get mortgages at 4.5, at 4.25, at 4.3. That's because the bond yields came down. Now that they're starting to tick back up. By the way, are they going to come back down? Yeah, most likely. But this is always creates a little havoc in the marketplace, Patrick.
Well, I think there's a couple things that we need to consider with all of this, right? Which is, we see the volatility, which speaks to what's going on in the general economy, the general marketplace, the feeling of discourse, the global issues that are happening. And there's a lot of uncertainty in there. So there's a lot of things that will affect bond yield, certainly what the economic outlook is. And I shouldn't say everybody, many are saying we're going into a recession or we're even in a recession. Others are going, no, we're teeing up for a soft landing in the next year, 18 months. So there's that uncertainty. So that will actually affect these bond yields, as will, for example, monetary policy. But then we look at the market and all of a sudden we see some inflationary pressures. And so we got investors some are fleeing to what they would call safety in a Government of Canada bond, and then others are getting out. And it's kind of all over the map. So I think this whole dynamic, this volatility will continue. And JG, we're already seeing what's happening. If there's not enough inventory because all of a sudden buyers are feeling pretty optimistic. Oh gosh, 5-year rates, 3-year rates, they're not so bad. Like you say, they're in that 4.5% range. And I can handle that. So they're going out buying. Now, as of next week, we see this influencer, which we talk a lot about. Interest rates are an influencer. And I think that if we kind of look over the past 3 years, we see what kind of an influencer they are on the housing market. So investors, you have to consider and think about where you see interest rates going into the future as well. And this is going to be based on bond yields in this case.
You talked about, this isn't even a sticky note, but I'm adding it in as a bonus, Patrick, because you talked about the R word, recession. And, it's so funny because I'm going to make a prediction right here, right now. I bet you here's what's going to happen. I bet you that they are going to, because often what happens is, if in case people that are watching this don't know, often, as in every single time numbers come out, those numbers get revised every time, all the time. All the numbers get revised. They first come out, then all of a sudden, a month or two or three later, sometimes it could take 6 months later, they revise those numbers. I bet you, Patrick, what's going to happen is in a certain number of months, maybe even a certain number, like a year from now, they're going to come out and say,
oh, we've revised those numbers. We were in a recession, but it's over now.
I bet you that's what happens.
Yeah, it could be. I think when we look at Canada, let's just look at Canada in what's happening and unfolding. So we look at GDP, which is a lagging indicator, even unemployment, there's a lagging. But so when we look into the future, we want to consider a few things of those leading indicators, for example. Now, I talk a lot about consumer confidence, and that is at an all-time low, which means people are spending less, which will, in fact, slow an economy down. What we're hearing as an example in the U.S. is a lot of these big corporations, these tech companies, literally laying off thousands of people. So as much as we hear that the U.S. economy is being quite robust, if you kind of look under the hood, if you will, we're seeing that really isn't the case. But now, why do I bring that up? Well, if you look at Canada, we're not getting those kind of announcements in any way, shape, or form. We're hearing more that I need more people. We need to do more. So if that's a leading indicator, we're not looking at unemployment spiking anytime soon. We will see it. We talked about this in the past, is that if it goes to 6.5%, we'd actually like that. The headlines will be, oh my gosh, the world is coming to an end. But if we know that the range of 6%, 6.5% is not out of whack for unemployment, then we look at that and go, no, we're still good. We're healthy. Ignore that headline. So the point of all of this is when we look at what's happening economically in Canada, if we look at leading indicators and we look at production and we look at manufacturing, all of those things, it's not great, but it's not bad news. Nothing there yet. So that's why I'm being cautiously optimistic. And to your point, I think in 6 months, we could see that announcement being made is that, okay, we're all good. We're good.
Yeah, exactly. Now, I will say this, though, Patrick. Let's come back to bond yields for a second, because I think investors watching this show, they're asking themselves, what do I do? What do I do with these bond yields? Do I rush out, get a mortgage now? Do I go fixed rate? Do I go variable rate? Where do I go? And I think let's first have the conversation about fixed versus variable. That's a conversation you must have with your mortgage broker. And the reason is because a fixed rate mortgage comes with very different terms than a variable rate mortgage does. Even though you might pay a little more on the variable side today, you might end up over time, depending on where you think rates are going to go, pay significantly less. And the cancellation penalties and the other terms tied to your mortgage can be better on the variable side. So it really comes down to, as an individual investor, where you're going with your game plan, where and when you're looking to exit your pieces of real estate in your portfolio. That all has a place to be considered as part of the overarching conversation. It's not just easily said fixed or variable. It's more complicated than that. And that's where you should engage, like a investor focused mortgage broker that understands the game, not a normal banker that's working at your local TD or BMO. They don't know this stuff. They're just going to sell you what they have on the shelf. But an investor focused mortgage broker can make that determination of exactly, should you go fixed, should you go variable. That's my advice, Patrick.
Well, I think we can't overstate that. We say this almost to nauseum, but people still don't hear it. They want to go what they think is this path of least resistance, and they sit down with the bank because they just happen to be there. I don't know. Work with a investor-focused mortgage broker. And JG, we've got trusted partners that they actually sit down, they do whole planning sessions around it, because that's how important it is. So I'm going to say it again. I'll keep beating the drum. Investor-focused mortgage broker, and then start to put a plan together. And then you understand where you even sit in the bigger picture. So I think that they literally are on the pulse of what's happening with mortgage rates, with bond yields, fixed term, short term, variable rates. They're dialed into that. So these, us having this conversation, we can give you that overarching, but to get into the minutia of it, you have to work with that investor-focused mortgage broker.
Before we move on, I just think this topic is so important because, as you said a while ago, it is, for us, interest rates are an influencer. And they're a part of the decision, but they're not the fundamentals of the real estate market. They influence the real estate market, but they're not the fundamentals of the real estate market. If you want more on that, you should definitely come out to one of our events at the Real Estate Investment Network. Come out to the upcoming Accelerator Conference, as an example. You'll learn more about that. But what I'm trying to say here, Patrick, is a lot of real estate investors or people who want to be investors, they make these buy, don't buy decisions. Should I get into the market? Should I buy another piece of real estate? Yes or no, based on today's interest rate. But that's a 20-year decision. And those interest rates are going to go up and they're going to come way down and they're going to go up and they're going to go down in your 20-year period. But sometimes, Patrick, literally people delay their entry into real estate by many, many years, if not ever get in because of these interest rates. I think that is a big mistake by real estate investors.
Big mistake. Big. Huge.
It doesn't have that much of an impact over the course of your entire career as a real estate investor. And you're in the game for 20, 25, 30 years. Man, your best friend is the time that you're in the real estate market, and you shouldn't let interest rates determine that.
I just want to expand on it one more kind of, let's keep hammering on this a little bit, is that interest rates are an influencer and they're very emotional. And that's because it affects those first-time home buyers, next-time home buyers. And when you're talking about buying a home for your family and, setting up camp, if you will, and having that place that you can call your own, that's a very, very emotional conversation. And interest rates really affect your decision-making process in that, because you're looking at your income, your paycheck, your household income with who else is going to be there. Am I going to have a roommate? Whatever the conversation is. As investors, we got to get out of that emotion, out of those headlines, and just do math. Full stop. Look at my strategy, look at my tactic, do math, take the emotion out of it, sit down with somebody, who is licensed as a investor-focused mortgage broker, realtor, accountant, whatever that might be, because you're putting a plan together. I can't overstate how important it is to get out of those freaking headlines that are speaking to first-time home buyers, next-time home buyers, and the general kind of retail populace, if you will, the retailer or the realtors, for example, who are trying to get deals done and there's no inventory. These are all emotional things, and we got to get back into the real data.
100%. All right, Patrick. Bond yields and rising bond yields covered. Sticky note number 1, complete.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.